Hey there, welcome back to Accessible Alpha, and this time maybe for something a little bit different. Typically I do the 5-minute, market analysis updates, from a trader's perspective to help you hopefully with your trading or investing or what have you. This time is the first of potentially many what I call industry insight interviews. So the idea is that I want to sit down with somebody in the private capital investment industry. Could be a hedge fund manager, could be a trader, could be an allocator, could be a fund admin. The basic idea is to provide a little bit more insight into what the hedge fund industry is like. And this interview is with Lance Baraker of Cap Intro Solutions. I've known Lance for a long time at this point. He was actually pretty crucial in getting Pantile off the ground in a few different ways. I'm really excited to bring you this interview. We talk about his past as an options trader, actually being on the floor and making trades, which is really interesting. We talk about what makes a successful trader. We talk about why you can be a great trader and still maybe fail in the asset management industry because the operations of your business are not very strong. And we talk about a million other things as well. Hopefully what you can take away is maybe how to trade a little bit more successfully if you're an individual trader. We talk about what he's doing now, which is basically helping emerging managers get their funds or asset management businesses off the ground. There's a ton of content in here that will hopefully help you with that journey as well. So a special thank you to Lance for doing this interview. I hope it's insightful for you. Let me know in the comments what you think about it. There's one more I kind of have queued up, and I'm going to release that, maybe in a month or so. But if there's a person that you want to hear from, or a role that you want to hear from, or you want more insight into a part of the private, kind of capital investment industry, let me know. Really happy to try to find that person, try to talk to him. But without further ado, here's the interview with Lance Baraker from Cap Intro Solutions. First of all, thanks for doing this. I really appreciate it. We were talking at lunch and whatnot about, we're going to get into some first loss stuff, some, what you're doing now.
Yep.
But first things first, I'll do like a little intro at the beginning of this, by the way, like, who you are, your name and stuff like that. Let's start with, what got you into trading? I'm just kind of curious, like how you started on this journey and how you got into trading and talk to me a bit about how you got into it.
Always loved math. My dad was always in the markets, so was real interested as a kid following the stock market, following stocks, learning about how markets work. And so, I worked with him. He'd always try to play the markets, try to develop different strategies. So as a young kid, he kind of taught me.
Yeah. So was he like a stockbroker or what?
No, he was.
He just into it.
Totally different he was in manufacturing.
Nice.
Like, different manufacturing companies from pharmaceutical manufacturing to moving pads.
Okay.
To all like different things, had nothing to do.
Yeah.
But was also really good at math and, wanted to invest his own money.
Yeah.
And,
so you just got into it that way. This is awesome.
Loved the stock market, did research, and try to follow, different companies, and, it was of interest to me.
Cool.
And so that's kind of how, I got into it. Read different books. And,
yeah. We'll talk about that a little bit. So, there's a Discord as well that I started where, like I said, students, younger traders, whatever it is, and actually one of the channels in the Discord is called The Library. And what we do is just post out books that we're reading. So like, I like some of the famous ones like Market Wizards by Schwager, like, things like that. But I'm curious, like, do you remember any of the books that you read that kind of were like, dude, this is really
some of the books was like by Tompkins on option pricing and volatility and volatility cones and, just learning to take data and to kind of compute, pricing and graphs, on that side. But like you said, Market Wizards, you know, when I was down on the floor as well, you know, you learn from a lot of the old timers, which was great. And, you know, one of the guys would just look and watch the tape.
Yeah.
And back then, and you're laughing because now, there was the tape. And
well, I laugh too because I know, just I like the Jesse Livermore book, or it's Edwin Lefebvre, but he has Reminiscences of a Stock Operator.
Yep,
right?
read
So
that
these
book.
are books.
That's great.
Back in I think it was literally released in 1927. And the reason why I laugh is these guys made so much money by just reading the tape. Forget technicals, all the internet, forget all that stuff we have now. They would just look at the tape and make a boatload of money. So I just think it's so interesting.
They will look at the tape, look at price action, and look at volume.
Yeah.
Because that's really what they, some of these guys, that I looked up to that were, much older, than me, and then been in the market for 15, 20 years, before I got into it.
Yeah.
And I just watch, and they constantly just I'd be talking to them, and I'd be talking just like you, and their eyes would be up at the tape. And they would, look at going by and look at the volume and look at the price action, and that's how they were taught, I guess.
And it's funny. So we'll talk about it in a bit too, because in a way that hasn't changed, right? Where even if we look at technical information, we're still looking at volume, we're still looking at price action. I mean, clearly the tools have changed and whatnot. But I do find it really interesting that the tried and true ways of doing this, at least from a concept standpoint, haven't really changed. But anyway, we'll talk about that. Maybe we'll talk about some algo stuff at the end or something. But so how did you get into this being your job, right? So if there's a lot of folks out there that are oh, I trade, options on the side, I have my Robinhood account, or and maybe they're in E-Trade or something like that, but they have, it does take a lot to get into the industry from a work ethic standpoint. I'm curious, how did you get into trading, doing this for a job, so to speak?
Listen, it was, I graduated Lehigh in 1993. It was a difficult job market, at the time. And I had some relationships, through family and friends that knew some people who were, basically brokers, down on the floor. And you
grew up in New York.
And I grew up in New York, born in Brooklyn, lived in Long Island, for the rest of my life, and went off to college. And so I'm a New Yorker, true. And, they knew some people that graduated, and it was a difficult job market. And went down there. And, fortunately for me, through, the family relationships, they said, hey, this company is looking to hire. And back then on the American Stock Exchange, it was really more of an option market than a stock market. As opposed to the New York Stock Exchange was the ultimate stock exchange.
And I feel Amex still exists, but clearly it's I just feel it's so wrapped in, does it still exist, or am I making that up?
The Amex.
I thought it wrapped into New York Stock Exchange, but there's still some stuff on it.
It did. It did. And but
and it was all options before.
So originally they had stocks. Some of the stocks I think I remember was Cheyenne Software and some of these other smaller names. Back then. So I'm talking early 90s, right? But to me, it was mostly, for me coming down there, was pretty big option exchange.
Cool.
At the time. So
that's okay. Cool.
But behind the SIBO, I think it had at the time, maybe 20, 25%, 30% market share. So it was
pretty sizable.
Pretty sizable.
Yeah. And this is, again, just from reading these older books and whatnot, I think we're so used to nowadays with, the New York Stock Exchange and the NASDAQ in the US, but there used to be stock exchanges all over the place, right? I know the Midwest had a stock exchange, this is before there was a lot of communication, I guess, between what was going on. You literally had to go down there. There had to be an exchange. That's where we're trading securities back and forth. And then, I don't know what, 70s, 80s, 90s, it kind of all right, a little more digitized, a little more kind of electronic transfer, so maybe it made it a little easier.
So the Midwest was an interesting exchange, at least from the option side, because what was really cool is they allowed us to cross stock out there. So when we were putting on a big option trade and we needed to, basically match up the option pricing with the underlying, a lot of times if we went to the New York or we went to the, on the Amex, there was a customer there, so we couldn't kind of cross stock. So what was the Midwest exchange? Was really an electronic exchange. Back then, and so we could just cross stock. back and forth.
Yeah. And what's the advantage of that? Like, why would you?
Well, I think the advantage of going to there is because if there was a customer or some other paper that was on the the bid and the ask, on that you would have to fulfill the customer rules and making sure.
Got it.
And it's not skating the rules,
right,
but we would go somewhere in between. And a lot of times, for whatever reason, that's what the Midwest became known as.
So in a way, it's almost like increased liquidity.
It
right?
is.
Okay.
Exactly.
Cool.
On the increased liquidity part.
So that's interesting. So if you don't mind, tell me about just kind of the ins and outs of like your first like job, right? So we get a real job. We're a professional trader. What's that like? Like, what do you do? What's the day-to-day of kind of that role?
Well, first you start out as a clerk.
Okay.
Right? And so my first job was with Timber Hill. Okay. Which is now Interactive Brokers.
Yeah, interesting.
So everyone knows.
Yeah.
So when we would start out there, they would train you. At that time, I went out to Chicago for a week. Okay. They would train you on, options and trading, and then you would basically become a clerk for, on the New York, on the Amex that I was, and then I'd learn from some of the older traders, and each of those traders were in a specific crowd or stock, meaning that, one trader might stand in Motorola, the other one might stand in DRG index, and they would do that, and I was just more of a clerk, making sure the trades, because back then we still filled out cards.
Totally. So I was going to ask you, and whenever you're like, what does a clerk do? Like, I know it doesn't exist anymore in a way, at least that I know of. Maybe that's untrue, but I think there's still like a flavor of it, right? Like, I think that you have something that's kind of helping the trader or the PM or whoever it is kind of execute their vision or what they want to do. But I'm curious, like, what did the clerk do? Like, you're literally taking the orders down.
So the clerk in the morning, we at the time with Timber Hill, we did have our option pricing were on kind of electronic handhelds. Okay. So we'd make sure all the handhelds were out there, batteries are in, pens are attached. Yeah, I love it. From that aspect, and made sure we handed that all to different traders. The other thing is we wanted to make sure that the traders had their sheets and their positions. So at the time, Timber Hill was a little more advanced with technology, so the systems just gave the pricing. So you still had to keep hand on your positions. Got it. Option price, basically pricing yourself as well. And so we'd have to make sure we run all the sheets. And then the other thing is we had tickets. You had to buy and sell tickets. Yeah. So you actually, when someone came into the crowd and sold you 100, calls, you had to write down, I'm buying 100 calls. Yeah. Write down the badge and do that. And then what would happen is you would take one piece of the ticket, you would give it the clerk would make sure that it goes down so they can record it and make sure that it gets processed, and then the next day there would be breaks because sometimes they didn't match.
Totally. I was going to ask you, like, and that's so when that tickets get handed in, and I promise I'm going to bring this back to like how it works now, so to speak, but I think it's really important to understand not only where we came from, but it actually still works this way, like in a way. And if you're really good at trading, I think you can exploit some of these things. But that ticket, was that like the source of truth?
That was the source of truth.
Okay. So if they're like, I wanted it at this, like here's my ticket with the limit on 100 or whatever it was, like that's what they go by.
That's what they would go by. They would match up. So what would happen is the broker would take his sell ticket, I'd have my buy ticket, and everyone else in the crowd, and they would take that, and they would gather those tickets, and then someone would actually punch them in. Yeah. And that's cool. And that's what it would be on. And then if the next day, if whatever reason, someone didn't hand in a ticket or if someone punched it in wrong, there would be a break, what we call an option break in the morning, and you had to make sure, like, okay, hey, this is what I know, you got to go to the broker and handle that and make sure you square that away. And that was it's all manual. That was all manual.
Well, but it's funny too, because, so when I set up some of my, trading systems and what have you, it's not manual anymore, but it still works that way, right? So if we have an OEMS and I'm typing in my orders and that gets fired off to the broker, we do these reconciliations that say, oh, well, the broker says you bought Apple at 183, and I'm like, no, I put my order in at like 181 or like whatever it is, and you actually have to like calculate the breaks. And I don't think, especially on the retail side, you probably don't see a lot of that, but like on the professional side, I'm like, well, it's actually a really interesting part of being a trader is like you have to make sure that what you want to happen in the market is actually happening. happening, you know, and kind of doing those reconciliations. That's cool to kind of do it manually. I like that.
Yeah, you have to do it manually, and you did all that, and you even did that when you were a trader as well. You know, besides being a clerk.
And do you find that really understanding kind of like how an exchange operates, like that's got to help you in trading, right? Like that's got to, I mean, you can have a strategy or what have you, or, you know, again, let's say you're an emerging manager that has a pretty successful strategy. I feel like understanding how the market actually operates and fills orders and doesn't fill orders or whatever, like that's really critical. I mean, I've made a million mistakes doing that, where you put in, like, especially options, right? You buy it at market or something and the fill price comes in and you're like, what? Like, why did it fill it at that? You know, and then you're like, oh, because I got to keep in mind, you know, volume, for example, or whatever it is. So,
it's extremely important to see the flow of the trade, right? To basically see the beginning and the end of it. Broker comes into a crowd, or if you're doing it nowadays electronically, you see, posted, electronically. You put in an order to buy. Are you grabbing that price? Is that the price that you got? Or did you get any better pricing?
Interesting.
On it, and then what happens? So, like, after that, the exchange has got to clear it, right?
Yeah.
It's got to go buy to sell, different clearing houses, right?
Yep.
The seller might be at Morgan Stanley. The buyer might be at Goldman. Down on the floor, we were clearing Spear, Leeds, and Kellogg's. So SLK. So each house had a different clearing firm, the buyer and the seller, and all that stuff has to match up. And so it's important, to get a good understanding of, it's just not magically appears the next day in your account.
And I think, like, it's always really interesting because again, when I first started, I opened up an E-Trade account when I was like 19, right? And trading to me is like a website, right? Like, I just go in, I hit the button, it like magically happens, and at the retail level, obviously that's completely fine. But I think like the really successful, shops or organizations that I look up to, it's like they really understand the operational aspect of doing all this, because that's the only way you can scale it out. Like, you're just not going to be able to fill, these. You can't unload $1 billion worth of Apple at market and have it happen like immediately. Like, like there's actually a strategy for how to get that into the market.
Right, so, and you could see it today, days and age, right? It was T+3, now it's T+1, right? So you could see, like, hey, it took 3 days, for a long time to clear trades. Now the technology and it's become so much better, so much more efficient. The clearing firms, and the exchanges are all together. That they can clear a trade in that 24-hour time frame.
Yeah, that's awesome. So And I know a little bit about your background, but like I said, share kind of anything you're comfortable with. Like, all right, so we're a clerk for a little bit, and then kind of what? Like, did we get our own books someday? Like, were we at a broker-dealer? Like, kind of how did your trading, we'll get to the first loss and the work that you're doing now, because I think it's amazing. But I'm just curious, like, where did you kind of go in your trading career? And maybe, like, if you're comfortable sharing it, like, why? Like, why did you take that route and maybe not another route? Or
I think in the beginning, as you became a clerk, and which was real interesting. And then at the time, my first job as a trader for Timber Hill was, and it was just the time as I started near the summertime, is I was there once I become a trader to replace any of the current traders who were on vacation in their crowd. So what I liked about that, and fortunate for me, was it allowed me to trade in different products. So one day I'd be in Eli Lilly, and then there'd be a specialist there, and then one day I'd be in the drug index, DRG, and one day I'd be in Motorola, and only because, let's say, someone took a day off or 2 days off, and so for me, it allowed me to, I did that probably for 2 months, in the summertime, and then I got handed my first kind of station where I was in front of was Telemex, which was the Mexican telecommunication company. So it was growing. They needed me to stand in that crowd. And most of the time back then, when you were on the floor, to trade and be allowed to trade, you'd have to stand in the crowd in front of that specialist. it's not like you can run into, some people could run into a couple of crowds, but to be participating in the full day, you really needed to stand in front of that crowd in that one specific area.
Yeah.
And there was different areas. There was an upstairs in the, they had the balcony, they called it, then they had the main floor, and then I was in the red room, in the Amex. So there's 3 areas. So it's not like, and there's probably 300 different products.
Yeah.
So it's not like you could trade all of them. You were specifically just trading, in front. And so that's where I was, trading Telemex and Telebras.
And is that also like a kind of a good idea in general, right? Like if you get kind of really good at one thing, or one thing really well, I mean, I feel like intuition would tell you you're probably going to be more profitable. Like, really honing in on what you know than trying to, spread it all over the place. And these are all options, by the way, right? We're not trading.
Yeah, it's all options. What was interesting back then was you get to know the brokers.
Okay.
And, so not saying that you knew their customers, but different brokers had certain order flow, that would come in. So you kind of knew certain directions. So we talked about reading the tape and the volume. You have an idea of standing in front after a year of how does the stock act, right, in different situations, right? Because you're standing there, you're watching it every day.
Totally.
Compared to the market, compared to itself, compared to, I was looking at what was going on in Mexico, and, I was trading it during the Mexican peso crisis, back then as well. So you could see that. You don't get that if you're trading 50 different things, right? Totally. So if you're just trading one thing, which is, the point you brought up is perfect, is hone your skill, on one, get to really know it, and that's what the specialists were there for. They knew, because they were there trying to guide us, to say, hey, there's the order flow coming in, this is what we're going to do. And you learn that, and you kind of read the tape of what's taking place. And it was all options.
Okay.
And then we would hedge the options, with stock.
Okay. Yeah, that makes sense. Because I think even when we say stay focused, right? Like I've had friends bring this up, or colleagues, or whatever, and they're like, yeah, like you stick with stocks. And I'm always like, well, it's not just sticking with stocks. It's like you may want to stick with growth stocks, or like value stocks, or like, I mean, I was just talking to somebody earlier this morning that they only trade in one sector. Like they don't even trade in anything else. Sure. Like they're only trading in healthcare. And again, like I think in the professional side of things, we see this a lot, but on the retail side of things, you don't. But the idea is like you play where you can win, right? Like you play where you know it best and you understand markets. And I don't know if you feel the same way, but I always feel like, well, you're actually going to lose money if you kind of deviate from that. And you're like, oh, Nvidia is the same as Procter and Gamble. Like it'll act the same way. It's like, no, it doesn't. No way. You know what I mean? So you got to like really kind of hone in on the things you know best.
Yeah, like anything else, it's an educational process, right? So it's you understanding and watching every day, and if you do something every day for 20 years, you're going to know exactly how that works, what doesn't work, what does work, from it, and so it does help. Obviously, listen, diversification in a portfolio, from a risk perspective, is great, and watching it, and but if you're on the floor at the time, you're focused on one or two, stocks that's standing in front of you, right?
Totally. I mean, and you can make a lot of money with one or two stocks, right? It's like if you know what you're doing, you know how to get in and out. And I think, like you bring up a really good point of really you're battling kind of the market in a way, right? And the market could just be that one stock, or it could be a whole asset class or a sector or whatever it is. But it's like if you really understand the ins and outs of that, I feel like most traders that I look up to, like they do that really well. Like, and they know what they're good at, and they know what they're not good at. They don't do the things they're not good at. But anyway, no, it's cool to and I see your point to you earlier where you said like it was good to get like a good, a good mix of everything, because maybe you start to identify earlier rather than later that like, ooh, like I really like this thing over here, and like maybe I don't really like this thing over here. Like it doesn't speak to me. Like I don't get it. Like maybe that person's making a ton of money, but it's like not clicking. So maybe that was like a cool experience to kind of be able to see all this stuff.
Yeah, and then listen, I remember this well. My first trade, so you're reading books, right? You talk about the first time you're getting into anything or doing anything. Like I read books, so there's calls, there's puts. Originally there was just calls, back then, and then they had puts as well, to do that. So I remember standing in the DRG index, which was the drug index back at the time, and I'm like, all right, a broker comes in. I'm like, this is my first day of trading. I'm like so excited. I'm like thinking, he's going to ask like, tell me, how the 300 calls, and you give a bid and ask, and how you always tell the size that you're up. So he walks in, and the first thing he asked me, he's like, give me the 400, 300 risk reversal.
Yeah.
So
I don't know.
I was like, so so he left the crowd, and I'm looking around, and I'm like, so I went over to one of the other senior traders. I go, this is my first day trading. I'm like, what is a risk reversal? Like, I don't even know. And he started laughing, and then you learn. And then you ask someone, and I figured out, on the first day, that's what happens.
Exactly.
It's not, it wasn't like, hey, here you go, tell me what these calls are and these puts are.
That's
on
awesome.
it. So it's a good experience.
It's funny because that story is perfect. It's a perfect way to articulate that when you get into trading, like you start small because you're gonna mess up. Like you're gonna do dumb things. Like you're gonna, and I think a pretty consistent thing that I see, and I don't know if you see the same thing, is like people maybe start too big, and there's a I just reread Market Wizards for like I don't know how many times I've read it, but I find it really insightful. But one of the interviews in Market Wizards, the guy says like people trade 3 to 5 times too big. They just do. And he's like, because especially when you're starting out, you're going to make the most mistakes. Like you clearly haven't been doing it for 20 years and all this stuff. So I'm just curious, like, again, I'd like to get to, what you're doing with First Loss and working with emerging managers. But do you find that to be true? It's like maybe people trade too much, or we think we kind of know more than we actually do, and then we get punched in the face by the market. And you're like, oh yeah, like
the hardest thing to do, I think, there's two things really are the hardest thing in my opinion to trading is to not do nothing.
Yeah.
That's the biggest problem. Yeah. So when I was down on the floor and I was trading eventually for myself, if the positions were working, sometimes you feel like you're getting bored, and then you feel like you have to trade.
Totally.
And if I could tell you, that's the biggest mistake, to do.
Okay.
Is sometimes you just have to walk away and not look at the tape. Not look at it and let your positions or let your strategy work in the way you're doing it. Because more and being bored or like, oh my God, there's nothing to do here, I have to do something and force it. Is a big mistake, right? To do that. And then I think the second hardest thing, just in general, is shorting. In general, just from a psychology, it's kind of un-American to short. Overall. But I think that's the probably one of the other hardest things. To do is short stocks.
So, all right, I was going to ask you, what are your what makes a successful trader? But I want to dive into that actually really quickly, because again, we were just talking about this morning with another meeting. But why is that true, that it's so hard to short? Because I remember when I first started out, and I came out of the academic world, which is a good thing in some ways and completely horrible in other ways. But you're like, oh, a short is just a negative long. Right? It's the same thing, it's just going the other way. And then you hop into markets and you're trading your own capital or someone else's capital. And it's amazing how not true that is. Like, to find a really good short trader, I think it's pretty rare. I don't know if you agree, but I think from
100%.
From like talking to folks, and again, my own mistakes that I've made, you think you can just flip it around and you can't. Like, it just doesn't work that way. But I'm curious, like, why? Like, from your perspective, like, why is shorting so difficult?
Well, I think it goes to the market psychology, right? Like, we're all taught, and then over time, markets go up over time, right? Yeah. So at the first, looking into it, that markets rise. So I think it's, from a shorting perspective. The other thing is, I think from shorting is there's two different types of shorts. Are you putting shorts on, or are you trading shorts to actually add alpha to your portfolio, right? Are you doing the same analysis that you would do on the long side, on the short side, and you feel you're convicted, and you feel that, hey, this stock should be lower than where its current price is?
Yeah, so you're saying, just so I understand, you're saying there's a difference between adding a short as like a hedge, right, to maybe increase alpha by reducing volatility, and then there's you're putting on a short as a speculation to increase alpha with your excess return, which is way harder.
Which is way harder, and it's different.
Yeah. Yeah,
it's different.
Yeah. So I remember I was in when I first got into this a bunch of years ago, I was pitching my strategy or whatever, and I had shorts and longs. I was market neutral, and this allocator at the time said, a bad short or a bad long is not a good short. And I remember being like, yeah, it is. Like, what are you talking about? Like, it's going the other way. And then you do this kind of year after year, you make a bunch of mistakes. And I think about it all the time because I'm like, that guy was so right. You know what I mean? Like, markets go down faster than they go up. Like, they go down, with much more volume and kind of ferocity. So it's like, if you treat them the same way and you're wrong, like, you're going to get brutalized. Like, it's going to be bad.
Yeah.
So it's interesting.
And it's pretty much, listen, like you said that, markets go down a lot faster. And then, even in the option market, what we call skew is, upside calls that are out of the money usually tend to be cheaper, lower volatility than the puts that are out of the money, because markets do go down faster. People want that protection. They trade at a higher vol or a higher price, from that. Not always.
Yeah.
Biotech stocks, it could be a little bit different. Take over stocks, that skew could change, in certain things. But in general, markets go down, volatility increases, goes much, faster, on that. So I think, in general in shorts. But then the other thing too is, when you think about shorts too, is most people don't think about this, is what is the cost to put on that short? And so there is a cost, right, to borrow that stock and short it.
Totally. And you mean literally like the financing cost from the broker to use that margin to borrow? Yeah.
The finance cost. Now, you could be right, but you could be wrong. And what do I mean by that?
Yeah.
If it cost you 40%, to pay in finance for that short, and you think that short's only going to go down by 20% over the next year, then why are you going to short that if it's going to cost you more than your analysis of what you think is going to go down?
And I think that's funny, because I'm a terrible options trader, because I feel like the timing is always what got me, right? Because you can be right with it, even forget the shorts, like even longs, right? Like, you're like, oh, I'm going to make money over time, and then the thing like expires or whatever, and you're like, dang, like I was right, but I picked too small of an expiry or something, or then I kind of lost it all. What about? I've heard before, and I completely agree, that you trade your personality. Like, you make your money based on like your personality and kind of what about options do you like? Like, why didn't you kind of start in options, but then maybe you could have gone to just like normal equities or the bond market or futures? Like, what about options was like really interesting for you?
For me, it was just, it was an interesting way to, kind of play the individual stock without playing the stock, right? You can get creative, in the portfolio.
Because of the leverage? And
the inherent leverage of options, different positions on. And then again, my job as a market maker, being down on the floor, is I wasn't directional. So it's a big difference. When you're running money right now and you're long a stock or you're short a stock, you're 100% directional, meaning in the sense of you're long that stock, you're making money if it goes up. You're short that stock, you're making money if it goes down. My job was to kind of trade the edge in the option market. I was hedging myself. So if I bought this option, let's say at $3, and I think it's worth $3.50, I would buy the option at $3. Let's say I bought a call, right? So if I'm buying the call, and I'm through my thing, I would buy the call, add it to the strike price, and then I would sell the stock simultaneously. And so by me selling the stock, buying the call at $3, if I had it worth $3.50, based on this volatility, based on this dividend, based on this interest rate, I'm technically locking in and doing an arb of 50 cents.
Right.
In my mind, if all of my variables are correct.
Yeah.
And that was, an interesting part. For me, trading options is trading. Actually trading and not taking a direction.
As I say, because you just need it to go kind of. It doesn't matter which way it goes. It just has to go bigger than that spread.
Right.
Right. And then we're looking.
And the other thing, two other things that I loved about trading options is what I just mentioned before. Either you can make money if it goes up, you can make money if it goes down. But with options, you can make money if it sits still.
True. Yeah, exactly. Yeah,
so now you have a third factor, right, where you can make money.
Yeah.
And you can make money on the weekends.
Yeah, true. Yeah.
When the market's not open.
Yeah. Because time is still going by, right?
You have time decay.
Yeah.
You brought up the point. I think the stat is, and I don't know what it is, but like 98% of options expire worthless.
Yeah. I've learned that the hard way a million times, yeah.
You know, you talk about timing and doing everything, or you could be right. How many times where, right before an earnings, right?
Totally.
Right. If you look at the at the money straddle, basically, let's say you looked at NVIDIA, right? Mm-hmm. And let's say earnings were tomorrow. I think the stock's trading around 130, 132. Yeah. And let's say that call and that put, that at the money straddle is $30, $15 for the call, $15 for the put. What it's telling you in basic, and you don't forget about getting into all the options, is they're predicting that there's going to be a $30 move, okay?
Yep.
In that earnings announcement.
Totally.
Now, if you agree with them, okay, great. Maybe you say, hey, I think it's going to be a $60 move. So you would buy the call and you would buy the put. You'd buy that straddle at 30, thinking that, hey, NVIDIA's going to move $60, or if the opposite way, you would, sell it on it. But let's say you bought that call for $15. The stock can go up, let's say 10, 12, 14, and that call would be unchanged.
Totally.
And now, so what happened? Because the volatility just got sucked out.
Exactly.
After an earnings announcement, after a news announcement, or if the stock moved. So, you have that other factor, the biggest, factor in volatility.
Yeah. And there's, you even know far better than I, but I know at least a couple traders, like their whole strategy is that, right? Like they've figured out a way to do really well with that. I mean, again, that's not something that I do or I'm not even familiar with, aside from school or messing around with it myself or something. But isn't there there's whole funds, I feel like, that just trade, volatility, like, options around earnings or announcements or, economic releases or whatever it is. I think that stuff's super interesting.
Yeah, they do. It's the math.
Yeah.
So they come down and they take a look at it and they run their math and they run their volatility cones and they run on it and they say, hey, we think here vol is 70, but it's trading 120.
Yeah.
So I'm going to sell 120 vol and it's going to revert to the mean of 70, or the opposite,
totally.
Holds true,
totally.
On it, just like anything else.
Yeah.
You sit and you're trading, you feel like, hey, the stock's undervalued or the stock's overvalued.
Yeah.
From that aspect of it.
That's cool.
But it's options are just for me it's a great tool, and you can use them there is defined risk. Yeah. In options if you put on certain positions, right?
Totally. We've spoken about this, but as a primarily equity trader, I only use options for like risk hedging, and kind of reducing exposure, getting out of 100% net down to 30 net, 50 net, something like that. And again, it's really simple, right? But it's just buying a put if you're long the stock, like a little under, maybe 10% under the current price or something like that. I roll them over every month, but that's about my use of options. But it's really helpful because that way you're kind of locked in. Like you kind of know what you're going to get. If the stock dips below that, your put's going to take over, and you're good to go in a way. So.
Yeah, or if you like a certain equity, let's say, and it's trading at 100, but you really want to buy it at 85, right? If you sell the 90 put for $5, right? Stock's trading 100, you sell the 90 put at $5, basically, and the stock goes down, you're going to be buying, if let's say it goes down to 85, you're going to be buying that stock at $85, right? So now you're buying, you're buying the stock. It's going to, it's going to get put to you, and then you get to buy that stock at the value that you wanted it. So selling puts is defined risk in the sense of most people don't really look at it. A stock can only go to zero.
Totally.
So you know what you're going to lose if you sell a put, right? On it.
That's
obviously,
cool.
If you sell a call, stock technically can go to infinity or on it. So there's no defined risk in that.
And I think the old like trading idiom in options, and again, this is certainly your world more than it's mine. But you'll hear sometimes, we sell puts like on the S&P, right? Like we kind of lay down the pennies in front of the steamroller, and it's I'm like, you got to do something other than that potentially. But it's like, it's funny how often I hear that, where it's like, oh, we just kind of sell puts because it's gonna keep going up. Tesla's gonna keep going up. Nvidia's gonna keep going up, and then like we saw in April or July, August of this year, you have these major corrections, and I'm like, I wonder how those guys are doing selling the puts.
No, it's listen, selling premium, like they said, is like picking up nickels in front of a bulldozer. On it, it could work for 11 months, and then in month 12, like you said,
you're out of a job.
It goes down, and I did that when I was not knowing, when I was trading Intel back in the heyday in the 90s. I used to sell a lot of downside puts, and skew was really off the charts, and a lot of these puts I would sell for $1.25, I had worthless. Right, and 9 out of 10 times they did go worthless. But the one time that they pre-announced, that $1 turned into $25, and you got crushed, and you lost your previous 11 months of P&L, and then some, and then another 11 months. So I agree with you.
Like if it's like maybe funding something else or something that's hopefully hedging that risk.
Right.
Because I do think, again, the academic background, we've done so much modeling over it, but it's like, oh, there's only a 1% chance that happens. I'm like, until it happens, then it's a 100% chance that it just happened, like, which is extremely painful.
Right. Like I used to say, sell a preem, collect the dream until you get creamed.
Yeah, it's so funny.
That's what happens.
Totally. So that's awesome. I appreciate you kind of taking that tangent. So let me get back to my original kind of question. So in your mind, what makes a good trader? I mean, this could be anything. This could be like a psychological mindset. This could be, we spoke a little bit earlier, you kind of stick to what you know, whatever. Like, I'm just curious in your mind, maybe we'll get into first loss in a minute here, but like as you're looking at an emerging manager, or maybe, a trader you've worked with for a long time, like in your mind, what makes a good trader? Like, why are they good at what they do?
Yeah, I think one is experience. I think the good traders have lost money before. I think it's very important. It'd be nice for everyone to come out of the gate and make money, but I think you learn more from your losses, right? And I think if you can learn from that, that's a good trader, because basically what you did, the first time. And in losses, you learn how you react, right? When kind of, what hits the fan, on it is how you're going to react, to it. And I think also, what makes a good trader too is, personality-wise and psychology-wise. I think, some of the really good traders, that I know are even-keeled, understand, take a look at it. Because trading is the greatest job in the world when you're making money. It's the worst job in the world when you're losing money.
Right.
That's the way I, look at it. 7 days a week, 24 hours a day, for traders, on it. But the psychology part about it, you can't get too hyped up, either way.
You're not, you don't have it totally figured out. You're also not a complete moron either, right? It's probably somewhere in the middle,
Right.
But I think that is really interesting, because I think, I've heard this a bunch. I've younger in my career, but I've experienced this already, where it's like, you're gonna lose.
Oh yeah.
You're gonna lose.
100%.
So it's not about not losing. I think you put it like a really interesting way. It's about when you lose, because it's gonna happen. It's like, what does that mean to you? Like, is it a number on a screen and you're like, it stinks, like, we'll figure it out? Like, is it, are we going home and not talking to the family for a week because you're like so upset about losing money? Like, I think that's really interesting. Because I feel like I've heard a flavor of that from a few different folks. That's cool.
To do that, how's it going to affect you? What you learn from it, and you get back out, out the next day, and you're out there and you're trading. If you truly believe in your strategy and believe what you're doing, for it, then it's a constant learning experience.
Yeah.
In my feeling, and I think the good traders are the people who've learned from experience, and it takes time, to do that, but understand different market cycles, from that aspect of it.
Yeah, that's cool. I think,
but losing is more. The losing aspect, I think, is more important than making the money. Especially in the beginning.
Yeah, I think that's a really good way of putting it. I think that's really cool. So let's, talk about what you're doing now. Like, what's kind of, so we traded options. What are you doing lately? Like, I know I'm playing dumb a little bit. I know a little bit what you're doing lately, but I want talk about it because I think it's really interesting.
Yeah, for me is I spent over 10, 12 years on the Amex, and it was incredible. At the time, and then obviously 9/11, payment for order flow, being 50 yards away from the South Tower kind of changed everything. Back then, and a lot of my friends and fellow colleagues, ended up leaving, and looking to start hedge funds or asset management businesses, and I didn't know what a hedge fund was back then, and you kind of learn the business. So I got into the introducing prime brokerage business, worked for different firms, and spent a long time just learning what it takes, as a business to build out a hedge fund business, from lawyers, accountants, to auditors, to infrastructure, to technology, through my path. And then eventually, the second aspect of it, which is, just as important. Obviously, you have operations and running the business and trading and trying to perform. But then the next aspect is raising capital, which is extremely important. And as I told you before, and I mentioned to you, it's a rare thing that someone who's running a hedge fund is great at trading and great at marketing at the same time. Usually you need that other person, or another team to kind of help you out in that aspect. There are people who are great at both, but it is rare. On that, and so you build relationships, on that side of the business. How do you? It goes back. How do you track capital if you weren't coming out of a huge shop like a Goldman or a Morgan or a Citadel or a Millennium or any of these huge Walleye, Verition, multi-manager shops, or come out as a huge analyst, out of these firms. It's difficult. So what do you need to find those institutional relationships or those high net worth individuals that will take a chance on you as an emerging manager and build that up. So I've built out relationships in that space where people would be provide capital matching against your capital that if you can put up. As you mentioned, first loss. I hate using. I didn't create the term.
We talked about this a lot.
On it. It was years ago. It was created. It's really not the best terminology. I like to say first gain, or kind of structured finance. On it, where a manager puts up capital that sits in a first gain and first loss position, and that institutional investor kind of gives them 10 times, on that capital, the allocation, meaning let's say you put up 500 grand, you could run a $5 million, managed account. So built out relationships on that side of the business. And then I'm also working with Intro Solutions right now as well, my partner Bob Marietta, and we have two products where we're not third-party marketers, but we built relationships out over the years, and we work with Dan Lancelotti and Paul Lavassier, who've been in the space for over 40 years, and they built out relationships where we have institutional relationships where our job is to go out, kind of match managers with institutional players that want to invest. So we get them the introductions and we get them the meetings, and it's up to them to sell the fund. Those are kind of the two areas that I'm focused on right now.
That's all. I mean, that's how we met, right? So I think that's amazing. And so we were speaking about this a bit earlier at lunch, but and it's so true. Like you put it so plainly, but it's so true. Where I think if you think of a hedge fund, you think of whatever. Yeah, this person that's a great trader, and then they make billions of dollars, and they're flying helicopters around everywhere. And I think from my own experience anyway, I'm like, A, that's not been true, and B, trading is just one part of this, right? Like you need to have great performance. That's how you're gonna, be able to solicit, capital and whatever. But they never talk about, you got to do all the reconciliations every month, or you got this accounting job you have to do. You got to go find, the order and execution management system. Like, there's so much to running this. And you said before, I'm like, this is running a business.
Yeah.
This is not, and maybe for some people it works out that way, but like, maybe what are some of the, if you were a trader, and let's pretend you're pretty good at it, like, what are some of the other things that you think it takes to be successful in this that has nothing to do with trading? Like,
sure.
we talked about, cap intro, but I'm just interested, like, what does it take to kind of make it in this industry?
They've done all these white papers. I think 50% of hedge funds fail, not because of trading, it's operations.
Yeah.
And so that's the key. And fortunately, today, better than 15, 20 years ago, as a manager, as yourself, you guys have a huge opportunity. You could outsource. There's so many quality people out there where you could outsource. It's not falling on your shoulders, where 15, 20 years ago, as you mentioned, everything was one-man shop, everything was falling on you, right?
Totally.
From accounting to, but there are great admin firms out there. There are great accounting firms out there. There are great lawyers out there, right? So you need the right documents and the infrastructure. You need to know what investors you're going after, and your documents allow you to do that and allow you to trade certain products and strategies, right?
Totally.
Just straight from that. And that's just conveying to the lawyer, like, hey, this is what I'm looking to do, this is what I'm looking to trade, right?
Totally. Yeah.
If all of a sudden, you're looking to trade futures and you don't have that, in your documents, then, you're already out the gate failing.
Yeah,
right?
totally. And there's like some very serious repercussions for that. So this is not just like, oh, whoops, I made a mistake. It's like, no, FINRA will shut you down.
Right. you need to discuss that,
yeah.
With your lawyers, and like, these are the products I'm looking to trade. This is what I'm allowed to trade. This is the concentration. This is all the different things that kind of make that up. And then auditing, accounting, fund admin, right? So most people don't realize, and they just go through it if you don't know what, like, your fund admin. So your lawyer does your documents. Mm-hmm. Your fund admin plays an important role just because they're going to be dealing with your investors.
Totally.
They're going to be sending out the investor reports. Yeah. They're going to be onboarding the investors. They're going to be taking the subscription into your hedge fund. Yep. So they're a key part of making sure, hey, they're going to be doing the KYC, they're going to be taking a look and dealing with that. So you need to have that, and you need to have a third party, because obviously what took place in the industry of people running off with people's money, I'm not mentioning names, and they're all public, you can read through millions of stories, on that, those, most of that time was, self-reporting or administrating. That's not going to work. So you have admins out there to do that, and then, obviously you have your accounting firm doing kind of the accounting work on a monthly and a daily basis, and then you have your auditor who's taking your returns and reviewing the accounting, and the admin work and auditing your results from that standpoint.
Yeah. And what you're working on now is kind of all these things, right? Or like, right, at least interfaces with all of this, because I think that's, anyway, you definitely talk about it, but I'm just to your point, there are solutions out there. You know what I mean? So this seems like a lot. It is a lot. It's something I personally deal with, running Pantile. But it takes a village. You don't have to hire all these people as like full-time employees. No. It's like you can pay them, whatever, project-based or retain, like whatever it is. But that's what you're referring to, right? Like, all of these things exist. You support it. Like,
you support it. And then also, I just did a webinar, and there was a family office investor on. It was pretty interesting. What he said is also your expense ratio. So I'm not asking you or telling you to go out when you're starting a fund and you only, let's say, raise let's say $1 million.
Yeah.
To go to the top tier and spend $400,000-500,000 on service providers, where you have $1 million and you just spend $500,000 of your investors' money. To pay on that. I know that's an extreme example.
That's how my first startup failed. We had a project, coded the whole thing up. It was beautiful. We spent, I think we raised, it was $5,000, friends and family. I spent $3,000 on lawyers.
Yeah.
And then we were like, well, that was dumb, because now we can't market it, and now we have to go back to work, So anyway,
right. No, that's investors look at that expense ratio, in that, and like I said, there's a ton of quality people where you can outsource. You have that aspect of it. And then the other important part where I spent a long time is obviously the prime broker or the custodian or the clearing firm, and trading systems, risk systems, as you know, how to trade EMSs and OMSs, order management system, and so from that aspect of it, you got to know the technology aspect of it. So set that up. Obviously, and take a look at that, risk parameters, and you mentioned before, fat finger rules, just in case you hit a button, and I meant to buy 100 shares. Oh, wow, that's 1,000,000 shares, right?
Exactly.
and you don't want that happening.
You're getting this margin call, you're like,
on the first experience. So, you set all that. So you have that whole, operation, aspect of it to do that. So there's a lot of moving parts. And then after all of that comes into play, you have the capital raising side, which could take a ton of time. And then you have the trading side, which takes, as I mentioned to you, it could be 7 days a week, 24 hours a day. You're involved in trying to build your craft out, and make it better.
And I think it's funny too, because if any of these fail, the whole thing fails.
It's done.
You know what I mean? It's like, if you can be the best trader in the world, but, and you mentioned this before, like you have bad systems, like it'll catch up to you, right? The accounting's not right, the returns are a little weird, they're changing all the time. Investors aren't going to trust that. Or great trader, great operations, not the best capital fundraiser. Well, you need more capital in the door to make some money here. You know what I mean?
You market. Listen, I've been doing this a long time, and I'll just tell you one story. There was I'm not naming names and names of the fund. There was an incredible trader, great background, MIT, Berkeley, you name it. Great schools, really smart, great trader. Had about $6, $7, $8 million, but he couldn't explain his strategy. Couldn't explain how he put the portfolio together. Couldn't explain the risk management involved. And there's nothing, not that he's super smart. But he couldn't convey what his alpha or what his, I'm not saying give away the secret sauces, but how he made the returns in the fund.
You got to get people to your level for sure, right? Like, and I think as a more quant-like manager, I mean, I've made that mistake a million times, right? It's like, well, how do you do this? And we get into models and AI and this, that, and the other thing, and they're like, yeah, we're not interested, and you're like, oh, okay. But then if you're honest with yourself, you kind of walk away from the table, you're like, how would I expect them to understand how I would compare to other managers they're also going to interview or think to allocate? If you can't have this compelling story that people walk away and they're like, that's awesome. Like, you know what I mean? Like, maybe we can get more information later or something, but it's like, that was crisp, clear, concise. Like, we feel like we totally understand. But yeah, that's really interesting.
To do that. So I said, you got to hire a marketer. I said, please. You have to. I said, you're super smart. I go, where you're going to fail is you're not going to be able to grow your assets. And so, listen, you could be at 6, 7, 8 million, maybe you'll grow it a little more, but if you have aspirations to run a couple $100 million and build it out to a business, it's not going to happen. I'm like, you got to hire a marketer. Got to hire a marketer and explain to the marketer, and then he can kind of give you, layups, and questions, so you can explain and prepare and be ready, for it. And I talk to a lot of managers today and try to, me and Bob, we try to just help, managers in that educational side. He went from 6 to 8 million to $800 million after he hired the marketer. So
I love that.
It happens. It happens.
I think that's awesome, because it's I think what you guys provide that is so valuable, and you said it before, like because I know Dan, I know Bob, I know you come at it from different, I think, areas of the business, but you've been doing it forever. Like, and I think that is so valuable, especially for an emerging manager where I didn't come out of Wall Street. Like, I didn't, I have experience doing a bunch of different things, but I wasn't a floor trader. Like, I don't have this experience that I think where you guys are really helpful is it's like, even the language you use, right? It's like there's a way to describe this such that you are getting your edge across, but it's in a language that people understand, right? Like, you're using, hey, long only equity, like, whatever it is, and people are like, got it. Like, at least I can put you in that bucket, and now you can kind of compete with the other managers in that bucket. But at least I can, like, evaluate kind of who you are and what you're doing. And I just, from conversations with you, but you've been, for me, you've been really helpful with that. You know what I mean? So that's
great.
That's
I appreciate
awesome.
that.
So we're wrapping up here. I want to do about an hour, but anything else you want to talk about on what you're kind of doing now, or anything you want to promote or talk about?
For me is I love the emerging manager space. I think it's exciting. I think what you guys do, it's incredibly difficult, incredibly hard, and I respect it. And it's awesome. And I love trying to help people in your position and other people, try to build their business, build their asset management business, see them succeed. Because that's the greatest thing is when someone starts out the stories that I just mentioned, where, all of a sudden you start out at, 3 million, 2 million, 5 million, and you grow to 500 million or whatever your aspirations are. It hit home, it's like, wow, this is an incredible success story. And it's great to see. And a lot of times the ego is left at the door, where dealing with some more established managers and larger managers, and even then coming out of big shops, a lot of stuff was done for them already. They might not even know how a trade settles. Totally. But I think in this business, it's a humbling business. You got to leave the ego at the door. And meet as many people as possible, and kind of learn, and we're here to help. Myself, Bob, anyone on the team, because it's nice. We love to hear those stories.
Yeah, I mean, it takes a village. I think regardless of who you are, or even regardless of experience or what have you, I think. From my own personal experience, and having a couple technology startups kind of earlier in my career. I think, and maybe you'd agree, but it's like you build firms by getting people around you that have experience or know things that you don't know. Right. And being honest with yourself about that, right? Because it does take some ego to kind of start a company, and you're like, I can do this, what I mean? Right. But it also takes kind of this paradoxical kind of lack of ego to be like, well, I want this thing to be as big as it can be, and I have never worked on Wall Street. I don't know how to market to family offices and whatever. Right. And I just think you guys do a really great job with that. Of hey, it takes a village, to get this thing off the ground.
It does. It takes a village, and there's a lot of help out there. Right, where at least in our industry, the alternatives industry, there's really a lot of good people, that can help you and want to see you succeed and help build the business. It's just like you said, do you want their help? Right?
Totally. I remember when I was at Boston University for my MBA, there was a bunch of doctors, like MD kind of doctors getting their MBA. And at first, me and my friends were like, that's kind of weird. You're a doctor. What do you need an MBA for, And then you talk to them and they're like, well, being a doctor has nothing to do with running a business.
Yeah.
You know what I mean? Hopefully you're a good doctor, you're a good trader at a fund, but it's there's way more to it than, being a good doctor. It's you scale your business, you actually make money, you earn income by growing this thing and make sure that's spitting off, profits and whatnot. And it was such a insightful experience, right? It was oh yeah, I thought you just had to be smart, and then you could kind of figure out all this stuff. Maybe being smart helps, but it's no. There's so much going on here to get a business off the ground, regardless of whether it's a fund or a tech startup or whatever it is. And it's cool that you're so kind of into helping emerging managers navigate that. Because it's there's a lot there.
Right, because it's like anything else. We've gone through it. The pitfalls, the mistakes. Right. So if you can help someone out, try to avoid them. Right. Listen. There's mistakes going to happen, especially on the trading side, and those are good, as I mentioned before, those are good things to learn from. But from a business or an operational side and building it, if you can help someone avoid that part, is a huge help to get off the ground and get started. It's one less thing that you have to deal with.
Well, cool. All right. Well, I say we wrap it here. Thanks so much for doing this, man.
I really appreciate it. You're the best. Thanks so much.
All right. Hopefully that was helpful. Again, special thank you to Lance Baraker at Cap Intro Solutions for doing this interview with me. We filmed it, a little bit ago. It takes a while to kind of come out, but as I'll be traveling, the next couple weeks, and I won't have the ability to get one of these market analysis or market update videos out to you. Hopefully this was a good kind of makeup video. So thanks for watching. We'll see you next time. See ya.